Zach. Our viewers are in for a treat today. It's the first time Zach and myself are doing the radio show together.
Sort of our inaugural show together, if you will. Can you believe it? They put us in here together.
I know. It's kind of scary. Good luck.
Well, in other news, summer is starting to wind down, even though the temps aren't. It sure is just absolutely blazing out there, isn't it?
Oh my gosh, it is just so hot. Even my swimming pool is like steaming hot. I did some landscaping yesterday, and I didn't get up early enough to do it, and I had other stuff to do, so I did it in like the middle of the day, and like an hour's worth of work, I had to go inside 3 times because I literally thought I was going to pass out. It was just incredibly hot.
This is that section of the year where I just wake up and think, could it possibly be this hot this early in the morning? I mean, it's already by 9 o'clock. We're coming into the office, and it's just like, how can it possibly be this hot this early in the day? Well, speaking of summer, hopefully you were able to get a vacation in as well.
Yes, we actually took a family vacation earlier this summer. Me and my family went to Costa Rica, which we got to go through a lot of different ecosystems there. It's pretty cool how diverse naturally that country is. But my favorite part, we did a cloud forest, and it was just really different, nothing I hadn't seen before, and a lot of really cool, amazing animals. Also caught my first sailfish. We did a little deep sea fishing, so that was pretty cool.
So I've got to ask, what was your favorite animal?
Oh, sloth by far. It actually wasn't even in the cloud forest. We saw them kind of in a volcano-ish area. But yeah, they're super cool. I've always been a huge fan of sloths.
And sloth's a great animal, isn't it? Well, that's pretty good. I also was able to take a vacation this summer. I always go back to my hometown, do that usually 2 or 3 times a year, visit family, usually on the 4th of July, which coincides with my birthday, and also Christmas time as well, of course. So did you do anything fun over the 4th?
We just had some folks over in my hot swimming pool. And had a barbecue.
Your sauna, your hot pool, rather.
Yes. I mean, maybe we could get an AC for the pool. I don't know. We have a pool heater, but not a pool air condition, so.
That sounds like a very Florida item, a pool conditioner, a pool cooler, if you will.
Yeah. Well, we don't have one. But anyways, as the summer is winding down, we're getting ready, at my house at least, starting up for the new school year.
Ah, very good. Well, your son Ethan, he's in high school now, right?
He is. He's a sophomore, so it'll be his 2nd year, and we're bracing ourselves because he'll be driving on his own in the next 2 months. So we've been actively shopping for a truck, as well as getting some of our back-to-school shopping done for school supplies and some clothes.
That sounds like a very fun summer on your end then. But that also reminds me that we have some tax-free shopping days coming up. The Florida Sales Tax Holiday runs a full month this year, from August 1st to August 31st. Some of the items free from tax include clothing, footwear, pens, pencils, notebooks, folders, and backpacks with a price of $100 or less per item.
And keep in mind, everybody can take advantage of these tax-free shopping days. It's, not just for school supplies. It's just buying anything for yourself that fits into those categories. However, it would be a great opportunity to buy some items for our annual school drive, which is in full swing until September 1st. You can bring in any new school supplies such as backpacks, pens, pencils, notebooks, folders to our office, and this is in partnership with A Gift for Teaching, which provides local children with school supplies that they need to have a successful school year. And all the donations stay in our community, so they go to Orange County schools.
And if you're joining us on the YouTube, I'm holding up a little flyer that you can find on all of our socials for the Back to School Supply Drive. As Christina mentioned, we are collecting donations for that. And we are also very familiar with the sponsor of this school supply drive, Gift for Teaching. The NFP team has participated in another one of their events for several years, the Great Big Backpack Build, and we really enjoy it. It's a good time to give back to the community. It's a very high energy event, always lots of fun. What is your favorite section within the Great Big Backpack Build, Christina?
Well, I unfortunately was traveling this year when we had it, but have done it many years in the past, and I just love the camaraderie. You kind of get like a whole team together from your office, and you all work together to build these backpacks, and you're putting together like 1,000-ish backpacks, and you're trying to do it as quickly as you can. They have some hype music and hype people. They really make it fun. It's just a great event.
They always have really good music, I find.
I agree.
Every year, it's good music. It's a good way to give back to the community, and you also get your steps in because it's a lot of running.
It's a lot of running.
Flat concrete floor, and you're just running all over the place, filling up these backpacks. It's really, you're trying to figure out how quickly can I put this stuff in the bag and zip it up.
And walk.
It's a lot of coordination, isn't it? Getting all together.
It is. And if you're really slow, the person behind you is like running into you and like
right. You don't want to be the one that can't get their zipper zipped all the way on their backpack.
The zippers can be tricky.
Then you're going to slow up the entire line. Well, anyway, on this week's show, we will be continuing the discussion that Joel started last week on the One Big Beautiful Tax Bill and dissecting some of the key components having to deal with the SALT deduction, the senior deduction, tips and overtime deduction, and the charitable deduction.
That is a lot of deductions, like deductions for everyone. Is anybody even paying taxes anymore?
That is a very good question. Well, as you and I well know, some of us certainly are, and we are still paying the full freight. So we are going to also do a deep dive on a semi-annual account statement. By now, you should have received your June 30th statements for your investment accounts. So we're going to discuss the top items that you should be paying attention to when you look at your statement, and it's not just the balance. So the next time you get a statement, make sure to actually pull it out and take a quick glance at it.
So first in financial news this week, the S&P and NASDAQ closed at record highs, reflecting strong investor confidence and optimisms in the markets. The Dow also flirted with its all-time high, despite concerns over trade developments and tariffs.
Very good. Well, both Alphabet and the Google parent company, Alphabet, and Tesla reported earnings after market close last Wednesday. Alphabet beat earnings expectations of $94 billion, and Tesla met expectations.
The FTSE, also known as the FTSE, closed at a record high, which reached over 9,000 points. This is United Kingdom's best-known stock market. International stocks have definitely had a better year this year.
Yeah, I would agree. Yeah, they absolutely have. So we're also going to take a moment and chat about an item that many folks have circled in red on their calendar. It's a date coming up August 1st, right around the corner, next Friday. So what does August 1st have to do with? Well, one word. Tariff. So we're going to talk about that real quick here. Several countries are beginning to pay those imposed rates ranging from 25 to 40%. Commerce Secretary Lutnick confirmed that negotiation talks can continue after the August 1st deadline, but payments must begin regardless.
That's right. The Trump administration is moving forward with new and revised tariffs on imported goods, especially from China. These changes are a part of a bigger trade policy, and on August 1st, that's the day that they'll officially go into effect, unless if Trump decides to push the deadline again.
Right, very good. Well, that is a game changer for a lot of folks. Well, hey, stick with us. Don't turn your radio dial. Don't click on that ever-enticing next YouTube video. We've got a lot coming up here on the program. You're listening to Dollars and Cents with Zach Keister and Christina Lamb of Nelson Financial Planning. So before we took a break, we started to have a quick chat about the tariffs that are coming up. We just want to remind you that's coming up on August 1st. So very important date to pay attention to. The next item that we are going to cover is the One Big Beautiful Tax Bill, also known as OBA.
That's correct. The House of Representatives and the Senate passed the One Big Beautiful Bill Act, which is a mouthful, also known as OBA, which President Trump signed on July 4th, 2025. It is a 900-page bill that covered a lot of ground, extending the current tax policies that were set to expire at the end of 2025 and that were put in place by President Trump's first bill, the 2017 Tax Cuts and Jobs Act.
Wow, 900 pages. That sounds like quite the summer reading list. Sounds like quite the book, if you will.
Yes, definitely don't want to be carrying that around.
So on last week's program, Joel covered half of the bill, which if you haven't seen, we encourage you to visit our YouTube channel, Nelson Financial Planning, and give it a watch or give it a listen on your favorite podcast provider. We will be doing a recap of his main points here. So here they are. The increased standard deduction that was set to expire at the end of 2025 has been permanently extended and included an extra inflationary adjustment for 2025, as well as an inflationary adjustment each year thereafter, bringing the standard deduction for 2025 for single filers up to $15,750, up from $14,600, and joint filers up to $31,500, up from $29,200. So very important numbers. I think most filers utilize the standard deductions nowadays anyways. Isn't that right, Christina?
That is correct, Zach. In the past few years, over 90% of filers use the standard deduction, which is a big change before the 2017 Act, where a lot of people were itemizing. So since there is the higher standard deduction, there has been such a dramatic decrease in itemization. And so now clients that itemize their deductions are pretty rare. Usually only folks who are like church tithers or give large charitable donations. We also see folks with high medical expenses or large mortgages, especially with the higher interest rates. Those are the types of folks that can still itemize.
Well, that makes some sense. And with such a high deduction nowadays, I can see why so many people are utilizing. So some other things that exist here. Lower tax brackets are also permanently put into law. The 10, 12, 22, 24, 32, 35, and 37% brackets are permanently put into law, which were not pre-2017. Most brackets were dropped by 3%. The $2,000 child tax credit was also made permanent, which was also set to expire in 2025, and will now be indexed for inflation, starting with a $200 increase for 2025. The child tax credit will be $2,200 per child. The 20% qualified business income deduction still exists. Here's a big one. The estate tax exemption was also extended. For 2025, it's $13.99 million, which would have dropped dramatically all the way down to $7 million per person in 2026 if the extension did not pass. That's a huge one.
It really is. And many folks thought that we would see an adjustment here and see some reform in the tax code because it was so high, especially compared to previous reform. This was an area the government could really generate some income for themselves. But they left it as it is, so I guess for now it's just business as usual.
Business as usual until Washington changes. So the estate tax exemption is something we certainly will be paying attention to and a close eye on within the tax code.
Yep. So our first topic on the One Big Beautiful Bill is the senior deduction, or also known as no tax on Social Security. So I really had high hopes for this one. I kind of believe it was misleading in the area of the tax code that truly has fell short over the years with the taxation of Social Security. Didn't quite meet my expectations. However, it does provide a $6,000 exemption for each qualified individual. And a qualified individual is at least 65 years or older by the end of the tax year. There are some phase-outs that apply, $75,000 for single filers and $150,000 for joint filers. Now, this rule only applies for 2025 through 2028. So keep in mind, if you're on Social Security, whether you took it early possibly, or if you're on Social Security disability, these exemptions would not apply to you if you're not 65 yet. So only those 65 and older will get the $6,000 exemption, and it is per person.
That is a very important distinction to make there. Mm-hmm. So another big section of the bill was no tax on tips. And this was, huge. A lot of people were very excited about this one. This is particularly huge where we are, tourist areas,
Absolutely.
Orlando area, and really Florida in general, where tipping culture is very, very important, from the theme parks to the coastal boat tours. Yeah, very, very important. So in the tax world, tips are discretionary payments determined by a customer that employees receive from customers. Prior to OBA, tips were treated as regular income and were required to be reported along with wages on a worker's W-2 form. The term cash tips refers to both actual cash and charge tips, as well as any tip sharing arrangements. So it's not just the cold hard cash that's subject to this, but it's also the tips received from the taps and the swipes and the bumps and however you want to pay nowadays. So the OBA provides an above-the-line deduction in the amount equal to qualified tips received during the taxable year. The deduction will be allowed for employees receiving a W-2 form, as well as independent contractors who receive the Form 1099-K from third-party vendor network transactions. The amount allowed for the deduction for any taxable year cannot exceed $25,000. The filer's modified adjusted gross income cannot exceed $150,000 for single filers or $300,000 for joint returns. For every $1,000 over the MAGI, there is a $100 deduction. This change appears to primarily benefit median income tip workers because those who make less than the standard deduction already owe no federal taxes, and those making too much money will phase out of the deduction. The rule is specific about what qualifies as tips. Cash tips received by an individual in an occupation where tips are customary and regularly received must have taken place on or before December 31st, 2024. This means that industries that were not previously receiving tips cannot all of a sudden claim the deduction.
Yeah, I think that's definitely going to be helpful for folks, especially in the Central Florida area. We do, like you said before, we do have a lot of people who receive tips and live off of that. So that's a good thing for them. Next on the big, beautiful bill is no tax on overtime, which also probably applies to a lot of our residents here. OBA provides for above-the-line deduction for the amount of qualified overtime compensation. The Act stipulates that qualified overtime compensation means that the employee must make more than its regular rates for an individual, and it must receive overtime pay of at least 1.5 times the amount that they work above 40 hours. And this is according to the Fair Labor Standards Act of 1938. The amount allowable for this tax deduction shall not exceed $12,500 for single filers or $25,000 for joint filers. This could be significant savings on a tax return if you have eligible overtime. So for example, let's say you fall into the 22% tax bracket, which is kind of average for folks, and you qualify for $25,000 in overtime pay deduction, which means, both you and your spouse have overtime. This would equivalent to a $5,500 in tax savings. So that's a pretty significant amount, if you have that overtime pay. So similar to no tax on tips, there's the MAGI phase out of $150,000 for single filers and $300,000 for joint filers, and phase out rules apply. So keep in mind, both for no tax on tips and no overtime, these are above the line deductions, so you do not have to itemize to benefit from them.
Very important to point that out as well. Well, we are diving into the one big, beautiful tax bill here on Dollars and Cents. We will be right back after these quick messages. Welcome back to Dollars and Cents. Today we are taking a deep dive into the one big, beautiful tax bill. The next item we're going to talk about is the SALT deduction. But Christina, I'm going to put you on the spot for just a moment here. I have a question to ask you, and this is your opinion, so there is no right or wrong. Where is the best French fry? It can be drive-through or it can be restaurant. Who has the best French fry out there?
gosh, I don't even know. I like when they're really fresh and really hot.
Okay, well, that's important. That's important. Yeah, you can't beat a fresh French fry when it's nice and hot with plenty of salt. But that's not the salt we're talking about here. And boy, I'm getting hungry, so we better get back to the program. So the salt that we are discussing today is the salt deduction. The bill expands the state and local property income and sales tax deduction for itemized filers from $10,000 up to $40,000. The new law still carries over the marriage penalty, meaning the potential for $40,000 itemized deduction is per return, not per person. Phase-out starts at $500,000 and is reduced by 30% of the income that exceeds $500,000. The rule applies for tax years 2025 through 2029. Good distinction. You get an extra year on this one. This has been a real sticking point for folks where state and property taxes are very high.
That's right, Zach. The taxpayers who own multiple properties or large value homes were previously aggravated over the $10,000 SALT threshold. The new $40,000 cap seems much more reasonable, especially with states with really high property taxes. As we're pretty lucky here in Florida, we have fairly reasonable property taxes, at least compared to some of the northern states. So next we have our new charitable deduction. So this one is starting in 2026. And yes, you have to wait an extra year for this one to start up. It's a charitable deduction that will be available for those who do not itemize. And it's $1,000 for single filers and $2,000 for joint filers. These contributions must be made to a qualified charity and do not include donations to donor-advised funds or supporting organizations.
You mentioned a very hot buzzword, if you will, that's been floating around the last couple of years. The Donor Advised Fund, the DAF, is a charitable giving vehicle that allows individuals to make a tax-deductible contribution to a public charity and then recommends grants from that fund to qualified charities over time. Basically, a donor contributes cash or securities to, say, a community foundation. The donor receives an immediate tax deduction of the contribution for that year. The securities are then invested and grow tax-free and are available for further deductions in years to come. This has become more popular over the last few years. Also, speaking of donations, we want to take a moment here to remind everyone about our school supply drive here at NFP that runs until September 1st. We are assisting a gift for teaching in collecting school supplies such as pens, pencils, paper notebooks, backpacks that will be donated directly to local kids here in the Orange County area that need those supplies to have a successful school year.
You know, I really like this new charitable deduction because as itemizing has become harder in the past for taxpayers, we saw a drop in charitable contributions. So hopefully this will encourage people to give more. So keep in mind the new charitable deduction for non-itemizing individuals is $1,000 for single filers, $2,000 for joint filers. And as always with any charitable deduction, you want to make sure you're keeping your receipts to support those donations. So additionally, within the law, there was a new threshold for itemized charitable deductions. So this is 0.05% of your adjusted gross income. So for example, if you itemize and you have $300,000 in adjusted gross income, your first $1,500 of charitable contributions will no longer count towards your itemization. So it was a little add-in they added there with the charitable deductions.
Oh, that's important as well. Well, another above-the-line deduction of up to $10,000 is for car loan interest on a qualified passenger vehicle loan for personal use only, of course, and secured by a first lien. So to get this, you must be willing to provide the VIN number, the vehicle identification number on the tax return. And the big kicker here is that the vehicle must have final assembly in the United States, meaning that the vehicle must be put together in the United States, but does not necessarily mean that it must have all United States parts.
That's right.
So just required to be assembled in the U.S. So maybe this deduction, Christina, is something that you should keep in mind when you're going new truck shopping for Ethan, your son.
Well, hold on. I never said we were buying him a new truck for my son who will be driving for the first time on his own.
Ethan, I'm trying here for you. I'm trying to get you a new truck.
We can barely afford the increase in the insurance that we're going to have to pay for adding him on. But he definitely does want to buy something American-made since he's looking at a truck. So, however, unfortunately, because we are not looking for a new vehicle, we won't be able to get any deduction. But keep in mind, for folks that might be car shopping, it is something you'd want to consider, especially if you know you want to get a new car. You may want to consider American-made and possibly financing instead of paying outright to get the nice deduction.
Okay. Well, one thing you mentioned in there, you mentioned a key term, and it really just kind of popped in my head here, and that is the above-the-line deduction. Christina, can you give us an idea of what a above-the-line deduction is?
Sure, Zach. So an above-the-line deduction means that it is counted before your adjusted gross income, which is also known as AGI. So the deduction would then help reduce your adjusted gross income, hence your taxable income. So you can take the deduction whether you itemize or not, which is a big deal. In the past, a lot of deductions were all a function of your itemizing on your return. With these laws, that's not the case. You get to take them regardless of whether you itemize or not. So it's important to note that also your AGI affects other things on your tax return. So the return will look at your adjusted gross income to see if you qualify for those deductions. So you keep hearing us using the term like phase outs. Those phase outs all apply based on your AGI or some function of it.
Oh, very, very important. So good to have that kind of idea of what a above-the-line deduction really is all about. Well, it sounds like there were some other notable changes in the big, beautiful bill as well.
Yeah, so there's many changes in the bill, and we are just highlighting some of the most important and what we thought would be most relevant to our listeners. Just a couple others. There's the termination of the new Green Deal. So this is a tax credit for new or previously owned electric vehicles, as well as the termination of the green energy provisions, which was for home improvements. Now, those are going to be ending as of the end of 2025, but they were previously going to end in 2032 and 2034. So this has drastically shortened the life of these credits. So if you're considering possibly buying an electric car, or possibly making any energy efficient home improvements, you may want to expedite those and make sure they take place in 2025 so you can take advantage of those credits. There was also the creation of the Trump accounts, which are savings accounts treated in the same manner as an IRA. These are for children under the age of 18. These new accounts have many rules and regulations, and we'll probably be covering them on another show as it's very extensive and convoluted. There was enhancements to the adoption credit as well.
Yeah, and we're going to do a quick little highlight here. And like you mentioned, I'm sure we will be covering Trump accounts on another program in more detail. But just to give a little bit of perspective, like you mentioned, these accounts are for new kids born between 2025 and 2028. They're part of a pilot program that will initially be funded by $1,000 per child. Contribution limits of $5,000 annually, but contribution must stop at age 17, not 18. They must stop at age 17, and no distributions in these accounts until age 18. At that time, they can take up to 50% of the account balance for college. But like you mentioned, I'm sure we will be covering that in much more detail in a different radio show down the line. Well, you're listening to Dollars and Cents with Zach Keister and Christina Lamb of Nelson Financial Planning. Stay right here. We will be right back. Welcome back into Dollars and Cents. Today on the program, we are taking a dive into the One Big Beautiful Bill. And overall, in all of its 900-page glory, it really didn't introduce that many new tax laws, but just permanently extended most of the code that was put into place from the 2017 Tax and Jobs Act and adjusted for inflation. Would you agree with that?
I would. I really would.
So do you think, with that in light, that many folks are going to see a big change in their tax bill?
Probably not, no. But as the saying goes, a penny saved is a penny earned, and all those little adjustments that the bill will provide will definitely give folks some tax savings. Also, I would say for those making $150,000 to $200,000 as joint filers and $75,000 to $100,000 as single filers, you're probably going to see a bit more savings, especially if you have tips incorporated into your income as well as overtime pay.
That makes sense. Well, the thing to really think about here is the savings is really coming from what would have happened had this not been put into place and the tax code would have rolled back. So that's just a coverage of the one big beautiful bill. We're going to transition real quick here. We're going to move into our last topic of the day, which is 4 questions you should be asking yourself every time that you're viewing your statement. So don't let your statement end up in the junk mail pile with credit card offers and those folks that want to check in and see how your car's extended warranty is doing. Actually crack it open and ask yourself these 4 questions. The very first question of 4 is, what do I own?
Yeah, so you want to look at your statement and say, do I know what's inside my IRA or 401k plan or brokerage account? This is one of the most important questions on our list. Without knowing what you own, it's impossible to know where your account stands.
So in each statement that you receive, it's usually a couple of pages, it should include an itemized list of your account holdings along with a ticker symbol, and often includes the name of the fund or the individual stock. There are several ways in which you can find out what you own if you're unsure. If you're a fan of research, like I am, there's plenty of informational sites out there that can give you a better idea on what it is exactly that you own. Of course, there is lots of informational investment sites out there on the World Wide Web, such as Yahoo Finance and Google Finance. There's also a ton of financial newspapers, such as the Wall Street Journal, and which gives lots of business and finance news, as well as Morningstar, who puts out a lot of information. And of course, we would be remiss not to include our own reference guide, the Next Gen Dollars and Cents, which has a wonderful glossary with lots of key terms and definitions as well.
Right, but you want to be careful about what sites you go to and how they may steer you in one direction or another. It may not necessarily be where you want to go. So one of the best places to find more information on a particular investment would be through the provider of the fund. Many companies will have informational sheets listed on their website that will give you some perspective on the funds, such as their performance information on the funds that you own. You should always be looking at the 1, 5, 10, and possibly the 15 or 20 if that information is available, to see if your performance is in line with that asset class. It's really important to do your due diligence early on, especially with 401k plans and IRAs, as those assets will potentially be invested for decades. Making smart adjustments early on can have huge impacts later on the value of your account.
And if you're not interested in doing all of the research, we would encourage you to reach out to your advisor and have a discussion on what it is exactly that you own. So the second question and things you should be asking yourself when you are looking at your statement is, what is my allocation? Because once you have the basis covered on what it is that you own, you then open the door to determining what your allocation is. Determining your allocation is very important, no matter what age you are.
So when determining your allocation, you want to review where the account stands regarding its overall mix, of which you may want to consider some changes going on in your life. Now, some believe the older you get, your allocation needs to follow a more conservative approach, We don't necessarily disagree with that statement. However, we do feel that there should be a blend of items rather than just being based on your age that are the driving factors. One size does not fit everyone. So keep an eye out if you see you're invested in a target date fund, which is very common for employer-based plans where there really is no one looking at your investment. Do you have a nice diversified investment structure within your plan of mostly large stocks, some bonds, and some international? So if you're investing in a target date fund, it may be a good time to have a professional look at your portfolio, maybe one of the certified financial fiduciaries here at Nelson Financial Planning.
Yeah, that sounds great as well. And just because you're retired doesn't mean that you need to shift to an all-bond portfolio either. Of course, in retirement, you will still need to have a growth perspective to keep up with inflation and help provide monthly income if that's your goal.
Overall, knowing your allocation is critical to understanding your portfolio and making wise choices about retirement.
Absolutely it is. So the third question that you should be asking yourself when you're looking at your statement is, what are my fees? Do you know how much money you are paying for this service of your account? Understanding the fees associated with your investment account is critical for several reasons, isn't it?
That's right, Zach. First, fees can significantly impact your overall return. Even small percentages can add up over time, reducing the amount of money you ultimately have for your goals. Knowing your fees can help you make informed decisions about your investments.
And if you're unaware of the costs, you might be paying for more than is necessary for services that you don't necessarily need. And, transparency in fees builds trust with your financial advisor as well. It also ensures that you are both on the same page about the costs and the services that are being provided.
Understanding your fees allows you to compare different investment options effectively. The comparison can lead to better choices that align with your financial objectives. Being aware of fees can help you identify any hidden charges that might not be immediately apparent. For example, there are 2 fees associated with almost all mutual funds. There's the underlying mutual fund expense charged by the mutual fund company to run and manage the fund, and then there's also the broker or financial representative fee or commission. It's critical to make sure that you are looking at your all-in expenses when determining fees.
Very important. Yeah, and these hidden fees can erode your investment returns without you even necessarily realizing it. So understanding fees can help you evaluate the value you're getting from your investment services. Are you receiving the level of service and performance that you would expect for the cost?
Being informed about fees can help you plan your investment strategy effectively, and knowing your fees can help you avoid any unnecessary expenses. This can be especially important if you're working on a tighter budget.
Absolutely. So, let's talk about some other items here. So as you're taking a closer look at your statement, that would be a good time to check your beneficiary information, making sure that you have names, addresses, and percentages correctly. You don't want to leave any undue headache onto your heirs once you pass, if you can help it.
Yeah, absolutely. Certainly here at the office, we have seen where people haven't had that planned out accordingly, and it does make it a little bit more difficult for your beneficiaries. It's also a good time to make sure that all your banking information is correct on your accounts and you don't have any old or closed bank information listed. As well, if you're receiving monthly income, you may want to check and make sure you have the appropriate tax withholding coming out of your distributions so you don't have a big tax bill at tax time.
Very, very important. So the next time that you receive an account statement, actually pull it out. Pay attention to it. Don't just immediately throw it into the trash, and ask yourself these 4 questions. Well, that's all the time we have for this week's episode of Dollars and Cents, brought to you by Nelson Financial Planning. Christina, I hope you enjoyed this program as much as I did. Well, time will tell. We'll see if they let us do this program together again or not. Well, anyway, if you like what you heard, you can always look us up on our website or give us a phone call. Our phone number is 407-629-6477. And yes, we still have live people that answer the phone when you call. We hope you enjoy the rest of your weekend. You've been listening to Dollars and Cents with Zach Keister and Christina Lamb of Nelson Financial Planning.